Okay, we're going to talk about capital budgeting some more in this chapter. And the last chapter, well, we've been on the topic of capital budgeting for a couple of chapters. Now we started with determining the cost of capital, and then we looked at the various uh, methods of evaluating projects and various methods like NPV, NRR, and MIRRs, and we knew that the cost of capital was important. With IRR or MIRR, you compare it to the cost of capital. NPV uses the cost of capital as an input in computations. Uh, so, uh, but all this while, we had um, basically a series of expected cash flows from a project that was given to us, and using that, we were calculating NPVs. But a lot more goes into forming those expectations of future cash flows from a project. Not to mention that since we're talking about the future, there is some risk that the cash flows will actually be a little bit different from the expected values. So, how do we assess that risk and manage it, right? So the intention is not always to eliminate risk because eliminating risk can become quite expensive, but um, trying to figure out how much risk there is and then making decisions based on that, Um, so that's the next part. But first, how are those cash flows determined? So we need to look at some details of a project. And here's the project. Um, and that's Gondolicious Corporation. It is in the business of floating gondolas in Venice, and the company is analyzing a proposal to float 2,000 gondolas per year. And according to Venice's anti-tourist dunking laws, a gondola can only have a serviceable life of 5 years, after which it must be scrapped. Um, so you can only use a gondola for 5 years. As per the local financial standards board, a gondola qualifies for a 5-year MACRS depreciation schedule, and we'll talk about that MACRS schedule in a bit. But that's how depreciation is going to be assessed. Gondolicious estimates that it would need to spend 1,200 euros to acquire each gondola, and then after 5 years, it can be sold or scrapped for 100 euros. Right? Um, each unit is expected to provide revenues of 5,000 euros per year. And the operating cost of each unit is expected to be 3,000, right? So we're talking about 2,000 gondolas, and each of them will bring in revenues of 5,000 per year, um, and it'll have additional costs of 3,000 per year, um, and each gondola will need to be purchased for 1,200 euros, right? Each lease. Then Gondolicious also expects to see an initial increase in its working capital requirements by 20,000 euros, right? So the working capital is basically money gets tied up during the project, and you can think of it as, say, money you would need to extend credit to customers, and it's a rolling credit. So you know the, you extend credit to customers who pay back in a month, but during that month you extended more credit to other customers who will pay back, but because it's rolling, you keep extending credit to other customers over time. You have some money that is tied up in that operation, right? And that would be an example of working capital requirement. And there can be several other things also, but a working capital requirement is of 20,000 means that it's going to tie up $20,000 for the duration of the project, and after that you can recoup it, right? Um, so initially it's 20,000, but then it rises to 22,000 after the first year of operations. And the company's marginal tax rate is 25%. Its weighted average cost of capital is 9%. Gondolicious recently paid 5,000 euros to obtain a business plan feasibility study. Calculate the NPV of this project. Is this an acceptable project, right? So to calculate the NPV, of course, we have to find out what the marginal after-tax cash flows are if the firm decides to take on this project. So we have to be aware of following things. One is that you should only use incremental benefits and costs, right? So the company has already been in existence. It has some revenues and costs already from its operations. So we should only be concerned about the incremental revenues and the incremental costs, the ones that get added on when we adopt this project. We had to determine if it's an expansion or a replacement project, right? So if it's an expansion project, we have added revenues, added costs. If it's a replacement project, or which means that we're replacing, say, an existing set of gondolas with new ones, then we would also have to worry about the lost revenues from the old ones. We'll just be looking at differences, right? And so the analysis will have to be in appropriate fashion. Do not include sunk costs. We cannot include sunk costs. Costs that have already been incurred, even though it relates to this project, we will not be able to recoup it. It's not coming back, whether we decide to abandon the project or take it on, right? So the example in this case was our business plan feasibility study, for which they had spent 5,000 euros. That's not coming back, whether you decide to adopt this project or not right now. So we don't need to worry about that. We should include all opportunity costs, right? So there are opportunity costs that, such as, well, if we had boats and already in our possession, if we had the gondolas already in our possession, and we use it for this project, then we lose revenues from the other project in which those gondolas were being used, right? So we'll have to basically say, well, we didn't have to buy new gondolas, but we lose revenues from what the gondolas were being used for already, and so that would be an opportunity cost, right? If you use a plot of land to put a factory on it, well, that land could have been used for other purposes too. So what would be the next best alternative? And that becomes an opportunity cost. Then account for all positive and negative externalities arising from things like cannibalization, right? What is cannibalization? Well, it is when you introduce a new line of products, but some of those new sales come at the expense of your old line of products. Think about GM introducing a new line of cars. Well, I'll sell some new cars, but some of those people would have bought the old cars or the existing cars that GM already was producing. So, we reduce the revenues from the other division, and we have to recognize that as an opportunity. As an externality. Complementary projects. Sometimes, making something like a Blu-ray player and Blu-ray discs, for instance, could help the company. It would help its sales. If it has players to offer too, then it can sell more discs, and so you basically say those are complementary products and would help the company grow sales. And of course, environmental issues. We need to recognize any environmental costs that we impose on the public, and it should be recognized as a real cost, because very often those costs go unrecognized, and we may think that a project is a positive NPV project because we really have not taken all the costs into account. Even if we directly don't bear the costs, um, the society we operate in will bear the costs, and you could lose sales, etc., due to that. Finally, we must use inflation-adjusted cash flows, and this is very important because we have an inflation component in the cost of capital itself. So the cost of capital is like any other interest rate, has an inflation expectation built into it, right? It's got inflation expectations built into it, and so we must recognize that inflation will have an impact on these cash flows. Um, and anyways, in NPV calculation, that means that the cost of capital in the denominator of present value computation is inflation adjusted, but if the numerator is not, then we will get basically an understated NPV. So for this project, it is being proposed as an expansion project, right? So we need to note the following: the $5,000 already being paid for the feasibility study, it's a sunk cost. A decision to adopt or discard the project will not impact incremental cash flows for the firm, hence it should not be included in our evaluation of the project. The initial capital investment is the cost of 2,000 gondolas, for which we spent 1,200 euros each. So that's 2.4 million euros, right? Now, the depreciation is going to be calculated based on that. This is the basis for calculating depreciation. Okay, working capital requirements initially increased by 20,000. So that's basically is another investment that will get recouped later, but originally we'll have to add that initial investment, and then a year later the working capital requirement rises to 22,000. So on top of this 20,000, there's another 2,000 which we'll need to add after year one, right? And so that's a cost, so it must be subtracted from year one after-tax cash flows. And since it's a working capital requirement, after 5 years, which was the life of the project, we will recapture all of this, right? It'll come back to us. So this must be added to last year's cash flows. Then at the end of the project, we must consider the after-tax impact on cash flows generated from the sale of gondolas. And this is calculated as revenues from sale of gondolas less taxes due on any book profits, right? Oops. Think up. Every year, with the 2,000 gondolas, we will have additional revenues of 5,000 each for 2,000 gondolas, which is 10 million euros, right? Each gondola's incremental operating cost is 3,000 euros. So 3,000 euros times 2,000 gondolas gives us 6 million euros. 6 million euros will be the operating cost on an incremental basis, and that is actually the variable cost, right? We must subtract this cost from incremental revenues. Although depreciation is not a real cash flow, it has real tax implications. So we must subtract each year's depreciation from revenues before calculating after-tax cash flows. Depreciation amount is calculated at the given year's 5-year MSCRS depreciation rate. And the MSCRS depreciation rates for major asset classes are shown in Appendix 11A of your books. So here it is. I pulled it up, and Here's the Appendix 11A. Actually, it's 11A-2, or Table 11A-2, but it's Appendix 11A, and talks about depreciation. And its most straightforward depreciation method is just straight line depreciation. So if you have a 5-year asset class, you take the value of the asset, 100% of it, and divide it by 5, and that'll be 20% each year for 5 years. But there are some more complicated ones, like a double declining method. This MACRS is actually double declining method with a half-year convention. Anyways, but that's allowed by the IRS. So what that means is that each year you can write down the value of our asset by this percent. The 5-year asset class actually goes into 6 years, sixth year, because of a half-year convention, right? And all of these numbers will add up to 100%, because by the end of you write off the value entirely and you get 100% off, right? So what is this depreciation monster? Well, it's basically what the tax laws allow us to do. Is of course, the best thing would be if we could just write off our entire purchase of gondolas, but it's not going to happen, because those gondolas are supposed to be provide service for 5 years. So the IRS says you're going to recognize revenues over 5 years, so you can basically recognize the cost of this purchase over 5 years. As a matter of fact, it happens to be 6 years, right, because of the half-year convention. But every year, this percent, 20% first year, 32% second year, 19.2% the third year, 11.2%, 11.52% year 4, and year 5, the same number. Year 6 is 5.76%. And all of these are going to add up to 100. So if these gondolas are a 5-year class. So what that means is that after 5 years, we haven't really depreciated it completely. So on the books, in your balance sheet, those gondolas will still have a value, which is 5.6% of the original purchase price, right? How did I get 5.6? Actually, it's 100 minus all of these added up over the 5 years, right? And since after 5 years there was only one more year remaining in the MACRS schedule, it was easy for me to just take 5.76% and say that's how much value remains in the book, right? If it was a 4-year project and we had a 5-year asset class, then after 4 years, it would only depreciate that much. So which means we'll take 11.52 and add 5.76, and that would be the value remaining, right? Anyways, that's how the MACRS depreciation works, and we will take that into account in our calculations here. All right, then after subtracting operating costs and depreciation from each year's incremental revenue, we have the operating profit, or EBIT, for the year. Okay, so the firm's incremental tax liability is computed by applying its marginal tax rate to the incremental operating profits. Okay, once the net operating profits after taxes have been determined, we must add back depreciation and adjust for the other non-operating cash flows, such as after-tax salvage value, additions to net working capital, etc., to obtain the project's net cash flows. The net cash flows and NPV calculations are here for this project, right? So one thing that doesn't change in this particular case is the revenues, which is we get 5,000 euros for each of the 2,000 gondolas, so it's 10 million euros, and these are numbers, all these numbers are in thousands, so we're dropping 3 zeros. So 10 million euros, the additional revenue for each of the 5 years of the project. Right? Variable costs or operating costs was 6 million euros, right? And so 6 million euros is the variable cost, and that remains the same, right? Then we use the depreciation, and we only subtract depreciation here in order to get the correct after-tax profits, right? And you can see in the end we add back the depreciation. So depreciation is not an actual cash outflow, but it helps us come up with the correct amount of tax that is payable, right? And so it impacts the cash flows. Right? So depreciation is 480,000 the first year, right? How do we get that? Well, according to the MASCRS schedule, the first year's for a 5-year class, the first year's depreciation was 20%. So 20% of what? Well, 20% of the initial investment. In this case, we have 2,000 gondolas, each cost 1,200 euros. So it's 2.4 million euros as the original cost. If you take 20% of that, you will get 480,000, right? So it's 0.2 times the 2,400. Now, that is different, again, right? We saw that. So that's going to be different for each year. And you can see first year 20%. We're looking at the 5-year class right now, right? 20% next year, 32, 19.2, and so on. So if we apply the correct percentages, then 32% is year 2 depreciation, and that 32%, 0.32 times 2,400 would give us 768. Year 3 depreciation was 19.2%, so it's 0.192 times 2,400 will give us 460.8. Right? For years 4 and 5, the depreciation in each of those 2 years is 11.52%. So 276.48 is 11.52% of 2.4 million, right? Or 2,400. We are talking in thousands here. So, anyways, so that's how we get the depreciation. And then the rest of it is just a matter of going down and doing subtracting. So 10 million minus 6 million minus 480,000 gives us 3.520 million, right? Or 3520 then taxes. The tax rate is 25%, so 25% of 3520 is 880. Right? 0.25 times 3520 is 880, and subtract 880, you get 2640. Add back 480. That was the depreciation. Remember, we only subtracted it to come up with the right amount of tax. But now that we're done with it, we add it back because it wasn't a real cash outflow. So once we add it back, we get operating cash flows. And that's what we do for 5 years to get the operating cash flow. For year 1, the only reason these numbers are different is because the depreciation is different, right? And you can see in years 4 and 5, the depreciation is the same, and so operating cash flows are the same, right? Okay, what else? Well, we already know that the initial investment is 2.4 million euros, but there's also an investment in working capital originally. This is at year 0, and that was 20,000, right? After that, after a year, working capital investment needed to be 22,000, so we had to put in another 2,000, right? So we subtract that, and that working capital, all of the 22,000, we are going to get back after 5 years out when the project is over. Now, so one more thing that remains, and that is the fact that we sold those gondolas, right? And we sold those gondolas for 100 euros each. 2,000 of those gondolas were sold for 100 euros each to generate 200,000 euros, right? Now, a part of that is taxable. So we got to pay taxes on some part of it, not all of it, right? Because we have to figure out if we made any profit, right? And the profits are based on the book value of those gondolas. And the gondolas were worth 2.4 million, right, initially. But we know that with the MSCRS schedule, even at the end of 5 years, they were not depreciated completely. They're not 100% depreciated. So their value is not zero, right? At the end of 5 years, um, there's still 5.76% remaining, right? I get that because there's a year 6 depreciation in the schedule that shows us, or you could just take 100% minus 20%, minus 32%, minus 19.2, minus 11.52, minus 11.52. So 100 minus all of these would leave you with 5.76%. And that's why the gondolas have value on the books of 5.76%, 0.0576 times 2,400,000 or 2.4 million, right? And so when we do this calculation, we get 138.24. So that's the book value of all those gondolas. Well, we sold it for 200,000, and their value is 138,240, which means there's a profit. Profit is the difference, 200,000 minus 138.24 thousand gives us 61.76 thousand, right? So that's the profit, and we have to pay taxes on that. What's the tax rate? 0.25 or 25%. So 25% of 6176 is 15.44, right? So that's how much we have to pay in taxes, right? So far we've just been doing calculations. So basically when we sell, we get 200,000, but we don't get to keep all of it because we got to pay taxes on any profits we made. And the taxes on the book profit come out to 15.44. So subtract that 15.44 from the 200 and we get a 184.56, right? So that's the net proceeds. It's the after-tax proceeds from the sale of assets, 184.56. That's a positive cash flow at the end. Now we add up all of these and we get the free cash flows from this project. Initially, it's a negative 2.42 million. It's 22.4 million for gondolas, working capital. Then it's basically 3120 minus 2 or 3118. Here's 234. It's just the operating cash flows. Then year 5, we've got the operating cash flow plus we get the recuperated working capital plus the after-tax proceeds from sale of assets. Add all these three numbers and you get 3275.68. And then we just calculate the NPV, right? To calculate the NPV, obviously that we've done enough. So go to cash flow mode, second C/C. For CF0, it's 2 minus 2420, right? 2420 negative. Enter. That's CF0. C01 was 3118. 3118. Enter. Go past F01 to C02. 3192. Enter. go to C03 is 3115.2. C04 is 3069.12. Enter, then go to C05, 3275.68. 3275.68. I'm going to enter that, right? So all the cash flows have been entered. The NPV, the cost of capital, I believe, was 9%. So to calculate the NPV, we input 9 as the cost of capital, and then go down, see NPV on the screen, hit compute, and you'll get 9835.90 or 9836, right? So that's the NPV. Of course, I'm going to give you a spreadsheet on which all these calculations are shown, and this is going to be available to you on Canvas as well. And one thing the reason I'm bringing this up is because there is an NPV function in Excel, but it doesn't do the right calculation. So if you give it, say calculate the NPV, so here's the function NPV, 9% is the cost of capital, and the cash flows are between C22 and G22, right? I gave them a series of cash flow. When we do that, it thinks that all of the cash flows occur in the future. Right? So if I include all of these, right? So if I say, give me NPV of all, whoops, cancel. All right, let me do this here. If I say equals NPV, right? 0.09, that's the cost of capital. Then I say, here are all the cash flows, right? And then hit enter. I get the wrong answer. I don't get, you can see that this is different. It's 9023768.99. And why? And the reason for that is that the NPV function in Excel assumes that all cash flows are occurring in the future. Like this one happens a year later, this one happens 2 years later, 3 years later, 4, 5, 6, right? But that's not the case because this one actually happens now, right? This is the initial investment. That's a year 0 cash flow. And all, so 0, 1, 2, 3, 4, 5. That's how the cash flows occur, but the NPV function assumes that it's 1, 2, 3, 4, 5, 6, right? All of those cash flows are in the future. So it is going to give us the wrong answer, right? So you have to be careful in using the NPV function. So when I use the NPV function here, I actually just gave it the address for the future cash flows, and then I know that the NPV is present value of all future cash flows minus the initial investment. So I add this B22 where the initial investment is. It's already negative, right? So I had to add it. I did plus B22, which means it's going to get subtracted. And then we get the right NPV value. So that's one thing I needed you to be aware of, that the NPV function in Excel is flawed. Okay, so that's cash flows. Now let's look at something else. We're going to talk about the fact that we know that these cash flows are estimates in the future, and there is some risk to such estimates, right? So let's look at another project. I made it a little bit simpler to calculate the NPVs in this project by making it a project which has basically future cash flows that make an annuity. So Solarium Incorporated is considering building a sanitarium on the sun. It expects to make a net investment of $90 gazillion, which will result in net increase in revenues of 30 gazillion per year for the next 15 years. the incremental costs are expected to rise by 10 gazillion per year. Solarium's cost of capital is 10% and its marginal tax rate is 40%. What is the NPV of this project? Conduct a sensitivity analysis for this project with a given change of plus or minus 10% in revenues, costs, and company's cost of capital. Right? So these are the ways of assessing and managing risk. So there's a sensitivity analysis that we're going to conduct. Then conduct a scenario analysis with the same change parameters, which means we're going to conduct the same scenario analysis by just looking at 10% changes in revenues, cost, and the cost of capital, right? So is this a robust project? We got to answer that question. Explain how you would proceed with the Monte Carlo simulation for this project. What additional information can you obtain from such simulations? So we're going to look at sensitivity analysis, scenario analysis, and Monte Carlo simulation, right? So first, of course, we are doing this because we recognize there's some uncertainty in the expected future cash flows, right? Let's see. In sensitivity analysis, we will just consider one variable at a time, right? Because the NPV of this project is going to change if the project's if the project's revenues change, if the cost of capital changes, also if the operating costs change. Either of those or any one of those could cause a change in NPV, right? So we'll just look at one of these at a time. We'll look at revenues and then we'll look at cost of capital, then we'll look at the operating costs and see how a 10% increase or decrease in each of them impacts the NPV, right? And then we can find out, once we find out which is, to which factors is the NPV most sensitive, right? We can focus our attention to that, right? So sensitivity analysis is useful in focusing our attention. It can ensure that managers spend extra time and effort in obtaining more accurate estimates for cash flow determinants or variables to which NPV is most sensitive, right? So for this company, Solarium, of course these numbers are in gazillion dollars, but minus 90 is the initial investment and 12 is the cash flow for 15 years, right? How do we get to 12? Well, we're told that revenues will go up by 30 gazillion, operating costs will be 10 gazillion, which gives us before tax earnings of 20 gazillion, tax rate is 40, so we subtract 40% of 20, that's 8 gazillion, and we get 12 gazillion. So 12 gazillion is the revenue year after year for the next 15 years, right? And so the NPV, of course, is simple because we've got a $12 gazillion annuity for 15 years. We'll find out what its present value is and subtract the 90 initial investment and we get the NPV, right? And that's what this does. So obviously, this is showing us the formula, but we can basically do this in the TVM mode. Second, clear TVM. I'm just going to say 12 is the payment, 15 is N, right? 10% is the given cost of capital, so 10 is I by Y. Compute PV, and we get 91.27, which is a gazillion, which is the present value of all future cash flows, right? I'm going to make that positive. Whoops, let me just store it. Okay, because I think I did use that plus key too many times. Anyway, recall one. So that's the present value of future cash flows, and minus 90 gives us which is the initial investment, gives us the NPV, right? So NPV is 1.27. That's what we have here. Now, what we do is go and change the revenues, right? So basically, if the revenue is down by 10%, then that means the revenue is 27, right? And cost is still 10, which gives us before tax earnings of 17, and subtract 40% in tax, which is 6.8, you get 10.2, right? So here in our calculations, we just have to do 10.2 as the PMT and compute PV again. And now this time we get minus 77.58. Of course, that's the present value future cash flows. So we make that plus positive and then subtract 90, and we get minus 12.42. So this is how, it's pretty simple right now, but we can calculate the various NPVs by varying one factor at a time. We raised the revenues by 10%, so instead of 30, it's 10% more, right? 20% of 30 is 3, so add the 3. And if revenue is 33, then we recalculate the yearly cash flows and recompute the NPV, and we'll get 14.96, right? We do the same thing with cost, right? The base case scenario, the base case scenario, our costs are 10, right? If they're lower by 10%, that makes it 9. If it's higher than 10%, higher by 10% makes it 11. And once again, the base case NPV remains the same, 1.27. It's the, with lower costs, we have higher NPV of 5.84. Higher costs, we have lower, in fact, negative NPV here, minus 3.29. Now, we're going to change the cost of capital. Instead of 10%, we will use 9% as interest in a present value calculation, or 11% as interest in PV calculation of future cash flows, right? And then when we calculate the NPV, we get 6.73 when the cost of capital is lower by 10%, and minus 3.71 when the cost of capital is higher by 3.71%, right? So now we just plot all of these on a graph. And we, of course, we know with the costs, if costs are down, that's better, we get higher NPVs, right? This is the base case scenario with 1.27 gazillion in NPV. When costs go down, whether it's the weighted average cost of capital or operating costs, we see that NPV rises, right? And when costs go up, NPV falls. So that's expected. So we're not worried about the positive or negative slopes, right? So with costs, we get negative slope. With revenues, we get positive slope. But because higher revenues means higher profits and higher NPV, and lower revenues means lower profits and lower NPV. What we are more interested in is seeing which one of these is the steepest, which one has the steepest slope, right? And of course, we can see that sales has the steepest slope. In other words, NPV is more impacted by any changes in sales. So our sensitivity analysis reveals that the project's NPV is most sensitive to revenue forecasts. And so if managerial resources are scarce, then we should prioritize our revenue forecast and direct managerial attention to ensuring that we have robust forecasts for revenues. All right. Next, let's talk about scenario analysis. Scenario analysis examines certain scenarios and how the project's NPV fares in each scenario, right? So we're going to build scenarios. For instance, if we have a best case scenario, and what would be the best case? Well, when uh, revenues are high and costs are low at the same time, right? Yeah. A worst case scenario would be when the costs are high and revenues are low at the same time. So we look at the best case, worst case scenarios. So we just have uh, those three factors that we were looking at. Of course, if tax rates are different, we could have different NPVs too, but that is exogenous, right? The company does not control how much the tax rate is. That's the government that controls it. So we don't we leave that out. We're only looking at the three factors in this case, which are the revenues and the cost of capital. All right, so we built the best case, worst case scenarios. So if we have revenues which are low, 10% lower, so instead of 30, it's 27. Cost, right, is higher. Instead of 10, it goes up 11. Cost of capital instead of 10%, if it's 11%. Then when we calculate the NPV, we're going to get a negative 20.97 gazillion, right? Our best case is when revenues go up by 10%, go up from 30 to 33, and costs go down from 10 to 9, down by 9%, and the cost of capital goes down by 10%. And then when we calculate the NPV, we get 26.07. Right, and so here's a graphic of that. Basically, the scenario analysis has revealed that the firm must be able to withstand a $20.97 gazillion loss, right, without risking its solvency. And if and if, only then we should actually take this project on, right? Because the worst case scenario does say that we could lose that much money. Now, let's look at simulation. Monte Carlo simulation is a little more involved process that requires specialized software or spreadsheet macro programming. But what's the reality is that you're not going to be doing any Monte Carlo simulation in an exam in this class, but you need to know what it is and what it does and what are the benefits of doing a Monte Carlo simulation. But here's the concept of it, right? So the manager either specifies or asks the computer to program to estimate a probability distribution. So there's a lot of historical data available for the company that's been taking on projects of similar kind for a long period of time. Then they can take all of that data and feed it in the computer. And the computer can basically estimate probability distributions for each of the factors. Or the manager can just specify a probability distribution, right? And of course, there are many kinds of probability distributions, and because the most popular one we know about or we talk about is the normal distribution, but there's the Poisson distribution, right? There's a binomial distribution, just a few, a few other, and then of course even without one of the common distributions that the computer can actually estimate empirical distribution based on the data. So anyways, but there is a probability distribution for each item, right? Then the computer program uses specified probability distributions and picks each NPV determinant at random. And it computes the project's NPV. And I'm going to show you, just so that the concept becomes clearer. I'll show you how this is done in a very crude spreadsheet in just a second. All right. Next, the program makes another random selection of all the NPV inputs and repeats the process. Right. So we're randomly getting um, values. In this case, in our case, there were three inputs, right? Sales, operating cost, and the cost of capital, which is randomly selecting number for sales, number for cost, number for WACC, and of course it comes out of a probability distribution, but given these random selections, we calculate an NPV, right? We generate hundreds of thousands of NPVs are generated in this fashion for the project. Based on all the NPVs calculated, we get the frequency distribution of our histograms of these NPVs are examined to determine its probability distribution and arrive at conclusions regarding the robustness of an NPV estimate and the probability or success of success or failure. So let's see. Here's a demonstration, right? So in our project, the base case scenario was 1.27, right? NPV was 1.27. Well, suppose we pick random values for sales and cost of capital and calculated an NPV, and it came out to be, well, somewhat higher than our base case, right? Then we made another random selection. We got another data point, which is a little bit higher still. The third one gave us a lower. Then we just keep on getting more and more. We are picking random values of sales and costs and cost of capital and calculating NPVs, and we got various points, and when we aggregate them, we kind of get a bell-shaped curve. A distribution comes out to be a normal distribution if we do enough values and we do average of averages. We get a normal distribution. That's the law of large numbers. And it'll have a mean of 1.27, and given its standard deviations, etc., we can then estimate what's the probability of having an NPV of 0 or greater, or a positive NPV, right? Because that's what we're looking for. Failure in this case is when we get NPVs less than 0, and the probability, of course, is the area under this curve, and it's, of course, we want that to be as small as possible. So that's what Monte Carlo simulation does. And I'm going to show you, like I told you, another one. All right, let's see. So here is basically, here's a spreadsheet that I'm going to I'll try to zoom out a little bit so you can see a little more. Okay. So what we have is sales, our base case sales, and what I'm told, basically, I'm just picking some numbers. I'm assuming that the sales have an average value of 30 with a standard deviation of 0.5, right? The costs have average value of 10 with a standard deviation of 0.1. And then the weighted average cost of capital has an average value of 10% with a standard deviation of 0.1%, right? And with these two, with the mean and standard deviation, is all you need if you want to define or assume that the underlying probability distribution is a normal distribution, okay? And because I'm just exemplifying the fact and not worrying about what may be right or not. Of course, the whole example is a hypothetical. Anyways, we'll say that my past analysis of data has revealed that this is the case, right? So given that, I want to draw random values, right? And I do that here. So here, what I'm saying is that I want norm.n INV, inverse normal. Basically, I'm trying to draw random values of a normal distribution such that um, such that a given um, number of those fall within a certain probability. In other words, I'm going to say, hey, uh, if I say, tell me what would be the value, right? Say, um, under which 45% of occurrences will occur. Well, I know that the average value is 30, right? So that means 50% of random selections in a normal distribution will be below 30, and 50% will be above 30, right? So if I say, uh, how many would fall below, say, 45, I know that number is going to be less than 30, right? And, well, um, how much less than 30? But, that's going to be determined by the standard deviation, right? Um, because if you remember, in the normal distribution, 68% of values fall between plus and minus 1 standard deviation from the mean. 95%, plus or minus 2 standard deviations from the mean. So as I said, 45, right? I just picked that number. But what I'm actually doing is saying, give me a random value. So this rand function here, rand, with nothing in between, just parentheses, it tells the Excel to give me a number from 0 to 1, right? So I'm talking about now a probability of 0% to 100%, right? 0 to 1. So it'll randomly picks a number, and then given that the mean is in C3 and the standard deviation of the distribution is in D3, it's going to pull that value. So if that rand function yielded 0.45, it's going to tell me number below which 45% of values fell, right? So I don't know exactly what the rand returned here, but I know that that number, whatever it picked, got me a sales value of less than 30, and that's why I was saying 45. It could be 47, 48, all right, or 0.48975 or something like that. It's less than 0.5, I can tell that because the sales value is less than the mean, right? And I do the same thing, randomly pick some seed value between 0 and 1, and based on that, given that the costs are 10, the standard deviation of 0.1, return a value for cost, and gives me, again, once again, this time we picked something less than 0.5, right? They did, or the rand function did. But here, actually, the rand function must have returned greater than 0.5 because we get 10.1%. As a matter of fact, because standard deviation is 0.1, that's 10. Well, I know that 68% of values fall between the first two, right? So it's going to be 50% until the median, then half of 68 is 34%, right? Above the median, above the mean. So 50 plus 34 is what, 84? So the rand function must have returned 0.84 to give me 10 plus 0.1, right? Which was exactly mean plus 1 standard deviation. Anyways, so based on these values, here I calculate the NPV for the project, right? And the NPV is actually negative 1.59. But we did that over here, did that over, look at that, 2,000 iterations. I get 2,000 iterations, right? And I have 2,000 NPVs with randomly selected values for sales cost and weighted average cost of capital. And to build a histogram, I've got a frequency chart here. We use again, Excel functions to build these frequencies. Yeah, and of course, given these frequencies, now I have a histogram, and you can see it kind of looks like a bell curve, right? Now, um, it tells me that the Monte Carlo simulation results, the NPV is 1.482, standard deviation is 2.298, and loss probability or probability of getting an NPV less than 0 is 0.263 in this simulation, right? But the reality is the simulation does not end here. It actually takes this mean and standard deviation of multiple simulations, right? This is a simulation of 2,000 randomly picked values for inputs, right? But every time, and this is a spreadsheet, every time I do an F9, I get a whole different selection, 2,000 different selections. And the mean changed a little bit, standard deviation changed a little bit to get new frequency distribution, right? But that gives, so I got two means, two standard deviation. F9 gives me another one, right? Every F9, recalculate, and I can keep on doing this many times. And you do this, so what happens is the Monte Carlo simulation actually takes results like this, and it'll take 1,000 of these results with the mean and standard deviation, and we get the mean of means, right? And actually just take the means, and we get a frequency chart of all the means, 2,000 means, and that is truly yields a normal distribution, and that's the law of large numbers. Anyway, so the Monte Carlo simulation will give us this result, and if we did that, we get this number, we get loss probability. We know that there's a 29.7% chance of losing money, but a greater than 70% chance of making money on this project. So it looks good, right? Anyway, so that's what simulation can do for us, right? But like I told you, you're not going to have to conduct a simulation in the exam. Just know about it and what it's useful for. Oops, I need to go to the next one. All right, this is the last item we'll cover from this chapter. It's called real options analysis, because very often we forget that we can change things during the course of a project. So Solarium's $30 gazillion expected revenue came from the following expectations. So remember, those are expected values, right? And expected values are probability weighted based on various events happening. So in this case, there's a 75% chance that the solar tourism will really take off, and revenues will be $40 gazillion per year. Alternatively, people might show extreme pyrophobia, and revenues will be 0 gazillion, not going to be any. Costs are fixed at 10 gazillion per year under any circumstance. So Solarium retains the option of shutting down operations after 2 years if people become too pyrophobic and start shunning travel to the sun. Will the addition of option to shut down add value to Solarium's consideration? And if so, by how much, right? So if we look at the fact that there is an option available that the company can use, any choice really adds value, right? So the question here becomes, how much? Well, in order to answer that, we're actually going to build a decision tree, right? Where we have a probability node. Usually in a decision tree, it's shown by a circle, and then so something that is not under our control. So probability of success or failure, probability of success 0.75, and in which case the NPV is going to be 46.91, right? How do we get that? Well, remember that this means that we are going to actually have $40 gazillion revenues. So instead of 30 in our original calculations, if we just used 40, right? And so what does that mean? Well, let's get this, let's crunch this out. So second clear TVM, oops. All right, now 40 is the revenues, right? The costs are still the same, so 40 minus 10 is 30, right? But we have, hang on a second, I gotta go back and see what our tax rate was. Okay, tax rate was 40%, 40. So 40 minus 10 is 30. Tax rate is 40%. If we subtract taxes, then we're left with 60%. So times 0.6 is 18. 18 is the annual cash flow. I'm going to make that present value. 10 is I by Y. Interest rate 15 is N. 15 years of 40 gazillion in cash flows. And compute PV, we get 136.90. I'm going to make that positive, minus the initial investment is 90 in this case. So we get 46.909 and 46.91, right? So that is what with success, right? All right, what if we have failure? Failure meant that people are not going to do this, right? So, and basically nobody wants to travel to the sun. Revenues are 0, which means we have 0 minus 10. So before tax cash flow is negative 10, but 40% of that we can save with our savings in taxes or tax write-offs. So 60% of that is minus 6, and minus 6 is actually the payment for 15 years. 15 is N, 10 is I by Y. Compute PV, of course, that's a negative value, minus 90. It's minus 135.64, right? So that's the NPV if we kept doing this for the life of the project. But if we get to abandon it after 2 years, what happens? Well, what happens now is that N is not 15, N is only 2. Right? We're not stuck with this project for 15 years. And then if we do compute PV, I get 10.41, right? And basically that's that, whoops. I remember it was 10.41, right? 10.41 minus plus 90, or actually minus 90 equals minus 100.41. And that's the NPV if we get to abandon after 2 years, right? So here we get these NPVs. First, with success, it's 46.91. With failure, we come to a decision node 2 years later, and if we abandon it, then the NPV is 100.41. If we don't, then of course the NPV is negative 135.64. Right, of course, of these two choices, then the negative 100.41 is preferable. And we do get to make a decision here. So this square node is a decision node, unlike the round node in a decision tree, which is a probability node. So that means we're going to get rid of this decision to keep, right? We can get rid of this decision to keep. Then failure means the NPV is minus 100.41. Success means NPV is 46.91. The expected NPV is 10.08 now. Why? Well, it's 0.75 times 4691 plus 0.25 probability times minus 100.41. And when we add those two, we get 10.08, right? And you can see this is much bigger than our original NPV for this project, which was only 1.27, right? So the difference between the two, 10.08 minus 1.27, or 8.81 gazillion, is actually the value added due to this real option we had with this project. So it's crucial sometimes to recognize if there are options in existence, to recognize that there are options in existence, and to take that into consideration in our evaluation. All right, well, that brings us to the end of this chapter. Let's see you with the next one.